today's. Okay, good morning, everybody, and welcome to today's Valuation Bootcamp being organized on behalf of the CFA Society Nigeria for participants in the 2021-2022 CFA Research Challenge. We have put together this Valuation Bootcamp to help provide all teams with a very an appreciation of valuations, particularly as it regards to the company being covered, so that everybody has a fair idea of how to go about conducting valuations. Valuations always tend to be the trickiest aspect in arriving at the investment recommendation. At the heart of the idea really is that at the decision of whether or not to invest in a company or not to invest in a company, you want to be sure whether the company you're investing in, the price is right. So you don't want to end up paying 100 naira for an orange that you could have bought at 10 naira. You want to ensure that you. Hello? Somebody says no audio.
Wally, I can hear you, so maybe it's from the person's device. I'll handle it in the chat room and go ahead. Okay. So basically, the whole idea of investment is you want to buy a product and you want to be sure that the valuation you are paying for that product is not higher than it should be. So if you want to buy an orange and the orange is say 10 naira, you don't want to pay 100 naira for a 10 naira orange if that was the price. You want to pay 10 naira or around 10 naira for an orange that is worth 10 naira. So valuation essentially is how we arrive at the process of valuing companies. How do we say this company is worth $10 billion, $5 billion, 1 billion naira? How do we arrive at that valuation? And in oil and gas, there are a bit of nuances to sort of observe, because oil and gas, the main thing for an oil and gas company essentially is that they're digging a hole in the ground, bringing out oil and selling that oil. And of course, there's gas as well, also selling that gas. So we know what the price of gas is in the national market. There's a market for gas. Its price is quoted. So if you just approximate how much reserves the company has in the ground, and you multiply by the price, that should be the value of the company. But however, there's a lot of uncertainty in investments. One, we don't know whether the reserves they claim they have is real. On the other hand, price also changes as well. So price of oil today is $80. Tomorrow it can be $100. Tomorrow it can be $20. So the whole process of how do we go through making a valuation call on an oil and gas company is what we're putting together today. And today we've invited Ayodeji Daudu, who is a CFA charter holder and is an equity research analyst who covers the oil and gas sector at Standard Bank Group Securities. Standard Bank Group, that's the parent company of Stanbic IBTC Bank. Ayo works there. Ayo is a very experienced investment professional. He's been around for some time. Like I said, he's vastly experienced. If you just look at his background, what he's been involved with for some time, Ayo has been involved in a lot. He's been around a lot of companies, a lot of sectors. So he brings very strong experience to the table. He has a bachelor's degree in accounting from the University of Kent, as well as a master's degree with distinction in finance from the Cass Business School. Prior to his current position, he worked at Investment One as an equity research analyst with focus on the banking sector. Thereafter, he moved to Telima, which is known as Exotics, as an equity research analyst before his current role in Stanbic IBTC in the Standard Bank Group, where he covers oil and gas. So Ayo is highly experienced. As I said, he has strong coverage over the sector, and we hope to tap into his experience for this session. He's agreed. He's put some slides together, and I hope you enjoy it. I think where we'll run is we'll try and run in a way that he'll deliver his slides, and then if you have questions, you can put your questions in the chat box, and then we'll take things from there. So, all right, please join me as I welcome Ayodeji Daudu to the podium, and I'll be.
Thank you very much, Wally. Good morning, everyone, and thank you for joining this session today. Um, as Wally said, I'll be going through oil and gas valuation. It's a bit different from your typical valuation process, but we'll go into the details of that as we go into the slides. I will just share my screen now. Just bear with me one moment. I think it should work now. Sorry, just a moment, please. Just having some issues.
Yes, we can.
Okay, great. So really, what we'll be going through in today's session is to discuss oil and gas valuation. We will start with really what makes oil and gas valuation different and really why we're having this session. We'll look at the various valuation methods that are used. We'll discuss why we probably won't use the typical valuation methods, such as your standard discounted cash flow models, your PE ratios, for example, as well as your price to sales ratios as well. Then I guess we'll focus on the modified discounted cash flow method. I'll explain why shortly. And then we also look at some of the relative valuation methods as well that can be used. And then lastly, we'll discuss some of the key metrics that can be used in terms of comparing company performances. Again, it's slightly different from your typical manufacturing or bank or consumer company. And as Wale mentioned as well, please, if you have any questions, you can drop them into the chat box and I'll try and pick them up as I go along. And please do ask your questions and so we can try and make this as interactive as possible as well. So just going into the session, and really oil and gas valuation is very different because for oil and gas company, I think one of the key things to take into perspective is that they are in the business of looking for oil and gas, drilling oil and gas, bringing it to the surface from the subsurface and selling it. As we probably have an understanding, oil and gas is a limited resource, and by that it will finish. By that I mean it will finish. It's not a renewable source of energy, so that kind of has a significant impact on the financial statements in terms of how they are created and put together, as well as the valuation as well, because your assets are not forever growing. Your key assets are your reserves. And by reserves that I allude to the oil and gas that you have found with a certain degree of certainty under the ground. And as you drill, as you produce these oil and gas assets, they decline over time. There may be some additions as you conduct exploration activities to look for more oil, but it will get to a point where your assets will start to decline because either you've not found any more oil in the region you're operating, or the business is no longer in the oil and gas sector, or quite frankly, I mean, we'll probably get to that point decades or centuries from now where there's pretty much no more oil underneath the ground. So I think that would be the first thing to highlight, is that unlike with conventional companies, oil and gas companies have depleting assets over time. The other thing to also mention is that an oil and gas company has relatively little control over the price of which it's selling its resources, its reserves. Oil prices are determined in the global oil markets based mainly on supply and demand dynamics. There are some other, what you may call externalities, such as conflicts, political interference. But one thing you can take away is that there's generally very little control over the price. That's for oil, and it's the same thing for gas. In Nigeria, there's a little bit more of control on the gas side, but for this presentation, let's assume that there's very little control over oil and gas prices. In addition to that, the price, oil and gas prices tend to be volatile or cyclical in nature, because again, due to the supply and demand dynamics. If you take, for example, the summer months of between June, July, and September, America, which is one of the largest consumers of oil and oil products, there tends to be a boom in terms of their demand, because that's seen as the driving season. So there's a lot of demand for petrol and diesel, and you tend to see higher oil prices in those periods, all else being the same compared to other periods in the year. Also with oil and gas companies, they're very balance sheet centric, a bit similar to banks in terms of their balance sheet is what drives their revenues and their profits. For oil and gas company, as I mentioned before, the reserves are what drives the revenues and the profits, because you're drilling oil and pumping oil from underground, which you've recorded as your reserves, and you're selling that. Without those reserves, you pretty much don't have a business. So the reserves are very, very important, and we'll discuss that shortly. Also, the accounting is very different, as I mentioned before. You see line items like depletion, which is, again, not necessarily the same wording in your conventional income statement. You may see a lot of impairment charges as well. You may see exploration as a line item as well, which again is not very familiar. And you may see things like levies as well, provisions for unwinding of amortized items as well. So generally you see very unfamiliar line items as well, which can and do sometimes cause a level of confusion. But we'll, as I said, we'll go through that shortly as we go along. So those differences really is what drives the valuation methods you can and cannot use. I think I'll start with the methods you can use. The modified discounted cash flow builds on the standard discounted cash flow method. Your standard discounted cash flow method, up to a certain point, you are able to forecast annual growth. But let's say after a 5-year period, you then assume the company grows at a perpetual level, as in it grows at a constant pace for the foreseeable future. That is not necessarily going to be the case with oil and gas company, because as I mentioned before, they have a finite or a limited amount of resources and reserves, which don't necessarily grow at a constant pace over time. They're actually declining at a constant or variable pace. over time, especially when you're not finding and discovering new reserves. So that's one thing to bear in mind, and one reason why we don't use the discounted cash flow model. It's also a similar case for the discounted dividend model as well. But with the dividend discount model, it's good to also bear in mind that oil and gas is a very capital intensive sector. There's a lot of capex required to drill, to search, and to produce some of these reserves. That's in addition to taxes as well, which can be volatile in nature, which means that your dividend discount model may not necessarily be applicable because your oil and gas company may not necessarily be paying dividend. And in addition to that, dividend discount model also assumes a constant growth rate, which again is not applicable to oil and gas companies. The last method, which is not applicable, is the price to equity ratio. The reason really why this is not applicable is mainly because of the significant depreciation, taxes, and impairments that you may see on an income statement, which can really drive the earnings considerably lower or even negative in some cases. But also to bear in mind is that some of your impairments, depreciation, some of your impairments, depreciation, and even taxes to a certain extent can be subjective and be subject to manipulation. So for example, you may decide to record a very high impairment charge on your balance sheet during a period of high profitability, so you don't pay significant taxes and it appears as though you have lower earnings. It's also the direct opposite, where you can record a recovery in impairment charges or reverse in impairment charges when your profitability is relatively low, to give the impression that you are making, I guess, more profit than you actually are. So I guess for those subjective reasons as well, price to equity ratio is not the best. You could also allude to the price to sales ratio as well, probably being not applicable for oil and gas valuation as well, given the volatile and cyclical nature of oil prices as well. In terms of methods you can use, as I mentioned before, the modified discounted cash flow is there. The net asset value is another method, and is actually one that's most popularly used. It builds on the modified discounted cash flow method, and incorporates a few more a few other different reserve levels that you would with your modified discounted cash flow. But I think for this session, it will probably be better to stick with the modified discounted cash flow because it's a bit easier to understand and to grasp. And maybe later, if you decide to go into oil and gas valuation, it's a nice transition to the net asset value method, because really it really just builds on the modified discounted cash flow method by incorporating some of the other reserves levels that you have in your balance sheet, I guess. In terms of relative valuation methods that are applicable, the enterprise value to EBITDA multiple is definitely one that you will see very, very often, because unlike the price to equity ratio, it takes away some of those significant line items that can distort your bottom line, such as your taxes, your depreciation and amortization and depletion, as well as your interest expense as well, which I guess, as I mentioned before, can distort your bottom line. And it gives you a better measure in terms of the company's operating performance and how that is, that is relative to the overall company valuation, which is the enterprise value. The enterprise value is really the equity plus the debt minus the cash and cash equivalents available. You also see that ratio actually quite often in the industrial sectors for cement manufacturers as well, because they have a similar issue in terms of highly capital intensive and significant depreciation amounts as well. The price to cash flow multiple is another one that is applicable to oil and gas companies. It's again, it strips out some of those line items that can be easily manipulated, as mentioned before, because you're working directly with cash. So you've taken away all the impairments, you've made adjustments for depreciation, and you've made adjustments for all the amortization and etc., which again can be subject to manipulation. And you're working with what is as close as possible to cash. And you're looking at that as a multiple of the price. That's the share price itself. So you've, unlike enterprise value, which looks at the company from the perspective of both the equity and the debt holder, the price to cash flow multiple is looking at it from the perspective of just the equity holder in that sense. And again, you'll be looking and comparing all these multiples to industry averages or to comparables that you may have to determine whether the company you're looking at is over or undervalued. In terms of the last multiple, the enterprise value to 2P reserves, I will go through that later on, but really you're looking at the valuation of the company in relation to its most certain reserves it has on its balance sheet. And by most certain, I mean those that it has a significant level of certainty it's in the ground and it's in the process of producing, or it has the technology to develop, or is commercially viable. But we'll go through that shortly. But like I mentioned, all these multiples are in relation to industry averages or comps that you may have. What you find is if these multiples are below the comps or industry value, you can allude to the company being undervalued or trading at a discount. But if its multiples are above the industry average or a comp that you may have, you may determine that, or you may assume or reach the conclusion that the company is overvalued relative to industry standards. But I'll go through each of those relative valuation methods in a bit more detail because they have different, you can arrive at different conclusions depending on the one that you are using. I've pretty much gone through this, so I will skip this slide. Sorry, Gloria, is it possible you can just indicate if I have any questions in the chat box? I'm not able to see.
Yes, sure.
Okay.
I'll keep in my chat box.
Okay, thank you. As I mentioned before, what we'll focus on in this session is the modified discounted cash flow method. Really, it's more for ease of use. It's not necessarily superior to the net asset value method, but I think for the level that we're at the moment, I think it will probably be easier to understand. So what it does, it builds on the traditional discounted cash flow method. So it follows the same process in the sense that you're discounting annual cash flows every year to arrive at a present value. But what it doesn't assume is that there's a perpetual growth rate, in the sense that it doesn't assume that after, let's say, a 5-year forecast that you've conducted and put together, that the company will grow at a constant rate of, let's say, 5% or 10%, which, as I mentioned before, is not necessarily realistic for a oil and gas company. Also, it assumes that there are no other addition to reserves, and 100% of the reserves will be produced until full depletion. And what that means is that, unlike the standard discounted cash flow method, which you are assuming a constant growth. With the modified, you are going to create a model that discounts the cash flow every year until all the reserves are depleted. So for example, if a company has reserves and is going to produce over a 20-year period, you'll be creating a discounted cash flow model for a 20-year period, which again differs from the standard discounted cash flow, which you probably use maybe 5 or 10 years, and then you would assume a constant growth rate afterwards. Also with this valuation method, it assumes a constant production decline rate. This is very important because, like I mentioned before, reserves are depleted, but also your production levels are not constant due to reservoir pressures, due to the general life of the reservoir as well. I'll try not to get too complicated, but your oil and gas field or assets will start producing from day one. The production rate will grow and it will reach a plateau, let's say after 2 or 3 years, where it's maybe reached 10,000 barrels per day. And that's the maximum it can produce due to the pressure in the reservoir, because really the pressure in the reservoir and the gas and etc. is what drives the oil to the subsurface. You can't pump gas into the well to increase the flow rates. That's the amount of oil you're producing per day. But even with that, it will get to a point where the production level will start declining. So let's say after 3 or 4 years, you reach your plateau or your peak production level of, let's say, 10,000 barrels. Your production will then start to decline. With the modified discounted cash flow method, you're assuming a constant production decline rate. You can discuss with management as well, or you can get some further clarity in terms of their presentation as what they see as a decline rate. But usually decline rate varies from about 5 to 10, 12% per annum over time. But I'll show a graph that kind of paints a better picture of what that decline rate would be and what the production profile will look like. Also, under the modified discounted cash flow method as well, there are no considerations for exploration. So you don't consider the cost linked to exploration and also the findings as well as a result of exploration activities. And really, it's because it's very difficult as an analyst outside looking in to determine how much can be spent on exploration over time, but also more importantly, what will be found on the ground and the quantities that will be found underneath the ground subsurface. So really, that's why.
Sorry. So there are 2 questions. Do I read it out? I think so that you don't make past the stage.
Okay, that'll be fine, please.
Okay, the first one is from Lukman. Hi, Ayo. You talked about industry average under valuation. Do you mean we can compare a company to the multiples of industry average other than picking similar companies to compare with?
So you can, you can do both, right? So you can take an industry average, so in the oil and gas sector, but you have to be very specific in terms of the industry average or the constituents of that industry, because oil and gas is a very broad sector because it has the upstream, midstream, and the downstream sector. So for example, if you're valuing a strictly upstream company that has no downstream exposure, no midstream exposure, it wouldn't be good to compare it with a company that has all those other business segments as well. It wouldn't be a fair comparison. So that's one thing to bear in mind. But yes, you could use those multiples to compare to an industry average or a selected few companies that you're sure of are in the same line of business as the company you're looking at. So you can take, for example, a Seplat, which is strictly upstream oil and gas, it wouldn't be fair to compare it. I think on the Nigerian Stock Exchange, Total is on the Nigerian Stock Exchange. They are both in the oil and gas industry, but Total is strictly downstream. So it wouldn't be a fair comparison to compare a Seplat multiple, let's say a price to cash flow multiple, to Total's price to cash flow multiple, because they're not in the same line of business. The two businesses are different in terms of cost, cost profile, capex profile, in terms of their revenue generation and drivers of those revenues. So it's better to focus on the companies that are strictly in the same line of business. I hope I've been able to answer your question there, Lukman.
Okay. So Nathaniel says he's a bit confused, like filling the gap between a beginner and a professional. Like, he's asking what are the steps you would recommend they take to completely grasp the modified DCF?
Okay, so I mean, we'll go through it shortly. I mean, this is just background information.
Okay.
But the steps you take in terms of your DCF is pretty much the same as you take in your modified DCF. One thing to highlight, the main difference is that you're not assuming a perpetual growth rate. That's the main difference. So what you're doing is you're discounting every year that the company is producing oil and gas, and you're discounting that back to the present value. The difference with that with the standard DCF is that you are assuming a perpetual growth rate. So if you have a good understanding of the DCF methodology, all you're doing is, instead of discounting for 5 or 10 years, you're discounting every year until the reserves are completely finished. I'm going to go through the modified DCF in a step-by-step
Okay.
a step-by-step method shortly, but hopefully at the end of that, some of the confusion should reduce.
Yeah, I think so. Okay, so the Manu asked the first question, says that he says thank you. So I think you answered it very well. He understands. So yeah, that's all for now.
Okay, great. So on the last point on modified DCF, as I mentioned before, you are forecasting every year until the reserves are depleted. But I think one thing to bear in mind as well, with most valuations, well, not valuation, but with forecasting, is that your level of precision, accuracy declines with the length of time you are forecasting. So, for example, I may be able to forecast oil price, oil production, cost levels with a bit more accuracy for 2022 than I will be for 2025, because really, I think it's only God that really knows exactly 100% what is going to happen in 2025. You can also argue that with 2022, but you have a bit more guidance as to what is going to happen in 2022. You're starting to see how things are shaping out in the oil market. Management have a better view of the amount of wells they're going to drill, the amount of oil they expect to come out of the ground in 1 year than maybe they do in 2 or 3 or 4 years' time. So really, that is directly applicable to this method as well. So what I'm going to do is I'm going to show a forecast of a 10-year period, and then I will show how we extrapolate that pretty much until the reserves are fully depleted. Because again, the level of accuracy will decline, and on a cost-benefit analysis basis, there's no point in you trying to forecast, a company over a 20, 30-year period with that level of accuracy, because really it's not going to come out as you probably wish, and as probably you would like it to be. So yeah, so I mean, before we go into the methods of creating a modified DCF, I think it'll probably be a good idea just to have a refresher on how income statements, balance sheets, and cash flow statements are linked. I believe everyone here is an accounting or finance student, so I'm assuming we're all familiar with the income statement, balance sheet, and cash flow. But sometimes how they're linked can be a bit confusing, and it will be very important, I guess, for this session as well to have a decent understanding. So in terms of the income statements, as you see at the left-hand table, the income statement's key lines are your revenues, your gross profit, your expenses, taxes, and at the very bottom line, you have your net earnings or your profit after tax. That net earnings or that profit after tax is reported in your balance sheet as well in terms of retained earnings. So you may already have existing retained earnings from maybe 5 years of operating. That net earnings or profit after tax for that year is added to your retained earnings after deducting dividends as well, dividends that are paid. So that's how the income statement is linked to the balance sheet. In terms of other key lines as well, you also see your depreciation in your income statement, which also feeds into your balance sheet as well, because it reduces your PPE, that's your property, plant, and equipment. It's the same in terms of amortization as well. It reduces that. I think as well, you may also highlight that interest expense or interest as well could have an impact on your long-term liabilities in terms of your borrowings as well, depending on whether the interest is accrued or paid in cash as well. In terms of how the balance sheet is linked to the cash flow statement, your balance sheet is a reflection of your company's position at any point in time. The cash flow records the changes on a year-on-year basis in the balance sheet position. So your cash flow will record the change in PPE. So we record the capital expenditure, we record depreciation as well. Your cash flow will record your changes in inventory, your changes in accounts receivable, as well as your changes in accounts payable as well. So if you have a look at the cash flow statement at the bottom of the second table, you see the starting point is actually your net earnings for that particular year from the income statement. That is then adjusted for all the non-cash items. So the depreciation, the changes in working capital, the change in PPE, mainly CapEx, because that's the cash item there. And really, that's pretty much how everything is linked. The bottom line from your cash flow statements, which is the change in cash flow, is also reflected in your balance sheet. So your change in cash flow is added to the cash brought down, which will be the cash in the balance sheet from the prior year. That is added to the net change in cash position for the year, which is also how the balance sheet is linked to the cash flow statement. I hope that's somewhat clear and it's familiar to everyone.
Ayo, LC just sent a question. Said, sorry for taking us back a bit. Is the perpetual growth rate the growth rate after the forecast period?
Yeah, so in your standard DCF, your perpetual growth rate is the growth rate after the forecasting period. So you may have, in your standard DCF, you may have forecasted a 5 or 10 year period, and then you're then assuming that the company is growing at a perpetual growth rate after that point in time. With an oil and gas company, because it's not forever growing, that assumption is not realistic. So that's why we are forecasting until the assets or the reserves are fully depleted. I hope that's a bit clearer.
Yeah, so she just acknowledged that she's not sure of the gender.
Okay, thank you. So moving on from how the financial statements are linked, I will spend a little bit of time trying to explain the reserves, because it's pretty much the most important aspect in oil and gas valuation. And it's probably the most complicated part of oil and gas valuation. So generally, an oil company will have reserves, and the reserves are a function of what they found subsurface as a result of exploration activities, or we can call it searching and trying to discover oil deposits or gas deposits around the world. I will probably talk from a Nigeria perspective more going forward, because I think that will probably be easier to understand. So as a company is searching for oil in Nigeria, for example, it may have an indication that there is oil under the ground. So for example, you take the Chad Basin in Nigeria, there are indications that there may be oil deposits there, but it's not yet been fully discovered. That would be what you may classify as prospective oil reserves. Those are the ones that have the lower chance of commerciality, and also the higher risk that what you believe it's underground may not necessarily be there, or the quantities that you believe are there may be substantially different from what is actually there. I'll try and repeat that again just to make it a bit clearer. So for example, if we're looking for oil in Lagos, because Lagos may be in close proximity to Badagry, where they've discovered oil, you may say that we believe that there's oil in Lagos, and it may be, let's say, 200 million barrels. You don't have a great amount of certainty on the amount of oil that is there. You just have a rough idea. That rough idea is probably what you would consider to be undiscovered, but also prospective reserves. In that level, there will be a best estimate, a high estimate, and a low estimate. So the 200 million barrels could be your best estimate. Your high estimate could be 250, and your low estimate could be 150 million barrels of prospective oil reserves. That one is not necessarily a reliable source of reserves to base your valuation upon, because there's significant risk that the quantities there, or the quantities that you believe are there, may not necessarily be accurate. So that reserves level is not included in most valuations. I hope that's somewhat clear at this point. The next level of reserves are those that are contingent. Those are sub-commercial reserves. Those are the ones that you have a bit more certainty as to their existence and also the quantities, but they're not yet either viable to bring on stream, as in to bring to the market and start developing, or there's not the technology to bring those reserves to markets, to drill and produce those reserves, or to develop those reserves, or you're still at the very early stage of evaluating and assessing those reserves. So that's why they're often called contingent. You could say they're contingent on technology, they're contingent on economics. So by that, we mean the viability, the ability for you to bring the cost of you bringing those reserves to markets and also being profitable. It may be a case of, like I mentioned before, the technology is not available, or the technology that's available is very expensive and doesn't justify the production or the development and the production of those reserves. So that's why we call them contingent reserves. And again, they range in terms of their level of certainty as well, as you see with the prospective reserves. The 1C are probably the most, have a higher level of certainty, down to the 3C reserves levels. It's a similar story with the proved, probable, and possible reserves as well. Again, they have a range of uncertainty, but what we are going to say about these reserves that the technology is there, it's seen to be commercially viable, and you have a greater amount of accuracy in terms of the level of reserves that's there. So these are commercially viable reserves. So they're either being produced, approved for development, or justified for development. So these are the ones that you would see in terms of driving your valuation. They would be your core assets or your core reserves that drive your valuation. I hope that's clear so far. So Gloria, do you have any questions so far?
No, no other questions. As they come in, I'll here.
Okay. And in terms of those proved, probable, and possible reserves, you have the 1P, the 2P, and the 3P. The 1P reserves, those are the ones with the greatest amount of certainty. Those are the ones that have a probability of recovery of about 90%. So those ones would constitute a significant portion of your commercial reserves. The next stage is your probable. Now, your probable reserves have about a 50% probability of recovery. The addition of your proved and probable reserves make up your 2P reserves. I repeat that again. The addition of the proved and probable reserves make up your 2P reserves. So the reserves that are 90% in terms of probability of recovery and above 50% are those that are your 2P reserves. So again, it's above 50%, but below 90% in terms of probability of recovery. Though the 2P is said to have the greatest amount of certainty of production, development, and commercially viable. The possible reserves, those are the ones that are less than 10% in terms of their probability of recovery. Those are the ones that, quite frankly, don't necessarily make it into your valuation. Those would be the one, like I mentioned before, the ones with 10% probability of recovery. The addition of the proved, probable, and possible reserves add up to the 3P reserves. But what we always focus on, or what is the core driver of the valuation, is the 2P reserves. You can also include your contingent reserves and reserves that are still under exploration. But the core driver of the valuation is usually your 2P reserves. That's the ones that are most commercially viable and constitute a large driver of the valuation. In terms of trying to incorporate the contingent and the prospective reserves, you would have to discount the reserves that are reported by the company. And by discount, I mean you would have to adjust for the chance of success or apply a risk factor. One thing that you would, or you should bear in mind, is that your 2P reserves tend to have a 80 to 100% chance of success because they're commercially viable, the technology is available, and some of them are already under production. The reason why there may still be only an 80% chance of success is that there may be certain risk factors that may affect the full production of those reserves. So for example, if you take Nigeria as a case, often we have reports of sabotage, theft, break-ins, breaches that affect production. That is a risk factor that can affect the full depletion of the reserves. And it's very important in valuation, and I'll discuss it a bit further. With oil and gas, the longer the oil is in the ground, the worse it is for the valuation because of the time value of money aspect of things. as we probably have a decent understanding, time value basically states that 100 naira today is worth more than 100 naira tomorrow or a year from now, due to risk factors, uncertainty, inflation, which is why we discount cash flows in the future back to present value. It's the same thing for oil. So if you don't produce oil today as you planned and you defer it till tomorrow or a year from now, the value of that barrel of oil is less than the barrel of oil if you had produced it and sold it today because of the time value of money. So when you have things like sabotage and breaches and etc. that delay existing production plans, it's a negative for your valuation because it means that the oil is left on the ground for longer than it needs to be. That's a bit different, or sorry, Gloria.
From Chibuzo, he wants to just confirm, does it mean if a company has discovered an oil field and are yet to acquire the working interest, is it referred to as contingent reserve?
No, not necessarily. So that is more of a economic consideration. So when there's been a discovery, regardless of the working interest agreement or the share that's agreed between the company, government, or some of its partners, the reserves are not affected by that. The allocation of reserves to the company is what is affected by the working interest or the participation level. So for example, if I have 200 million barrels of oil as contingent on technology, economics, etc., my working interest, if it's 40%, means that I have a working interest in that contingent reserve of about 80 million barrels. It means the amount of reserves that I can hold as my own in terms of assets in that field. I hope that makes sense. So the idea of contingent is not affected by the working interest, but it's more to do with the commerciality in relation to technology costs or the level in which the reserves are at in terms of their development. The working interest aspect of things is really the negotiation of the share interest in that reserve, which is determined between the government and the company and its partners.
Okay, that's all for now.
Okay. So as I mentioned, you can incorporate these prospective contingent reserves into your valuation, but you would have to really incorporate a risk factor because, as I mentioned before, these are more high risk reserves levels. So like I mentioned, with your 2P reserves or your probable and proved reserves levels, those are at a region of about 80 to 100% chance of success. As you move down to the lower reserves levels, those with a lower chance of commerciality, the chance of success declines. So with your contingent reserves, I think on average, you're looking at a chance of success of anything between the region of 40 to, let's say, 70%, depending on what level they are in terms of their development. And again, that's very subjective and it differs across analysts and differs across companies. And it also differs across regions and terrains. In terms of the next level down, your prospective reserves, those ones are the ones still being explored and still being searched and discovered and are probably the most highest risk level reserves. And those are the ones where you tend to see a chance of success of 10 to maybe 30%. And again, like the other reserve levels, they're very subjective in terms of what you may see as analysts applying as a chance of success. So that's why, again, for this level, I think it's best for us to focus on the 2P reserves, just for, again, for simplicity and not to complicate things too much. But when you get to other valuation methods, like the net asset valuation method, you often see a lot of analysts incorporate the 1C or 2C contingent reserves in terms of their valuation, as well as the exploration assets as well. And you will see them applying a chance of success factor to that as well. I hope we're clear on this reserves discussion, because as I mentioned before, it's very important in terms of the oil and gas valuation and how you see things on balance sheets and company presentations.
I think so. There are no questions in the chat box right now.
Okay. So I mean, once we've determined what the reserves levels are, and just to mention, the reserves are often provided by management, and the reserves are assessed and confirmed by independent party. Because again, you don't want management being the ones to determine the reserves level for the company, because again, it's subject to manipulation and the likes, and could be seen to affect valuation, because again, that's the determination of your valuation. So looking at the production profile, your reserves will drive your production. The more reserves you have, the more likely you are to produce more over time. I repeat that again. Your reserves will drive your production profile, because the more reserves you have, the more likely you are to produce in any given period of time, and the more likely you are to produce over a longer period of time. So a company that has a reserve level of 200 million barrels 2P and is producing, let's say, 10 million barrels a year, that company can produce over a 20-year period, compared to a company that has a reserves level of 100 million barrels and is producing 10 million barrels a day, 10 million barrels per year. They will only be able to produce for over a 10-year period. So the company with the 200 million reserves level would have a higher valuation, all else being the same, as in they have the same cost profile and capex. The company with the higher reserves base would have a higher valuation because of that ability to produce more over a longer period of time. Now, in terms of production, your production profile, as in the production per annum over a period of time, will be determined by a work program and budget that the company has. They may not necessarily share this in all cases in their presentations or income statement, but they'll usually give a guidance into the number of wells that they plan to drill in a particular field, the capital expenditure they expect to incur as a result of that, as well as the number of barrels of production that they expect to come on stream as a result of that well. So I'll repeat that again. The field, let's say OML 11 has a field called Daudu, for example. The Daudu field will have multiple wells that have been drilled over time that are producing barrels of oil. Next year, they may decide to drill another well that maybe costs $10 million. That well will produce another 2,000 barrels of oil per day going forward. And that production may increase over the first 1 to 2 to 3 years. It will then peak and start to decline over time. That's the details and information that are usually provided in your work program and budget, which will drive your capex forecast as well as your production forecast. It may be a case of management only provides 1 year guidance in terms of what they expect in terms of capital expenditure and production. You may use that and then assume a constant decline rate over the remaining life of the field. They may provide 2 or 3 years, which would then, I guess, provide more accuracy or guidance in terms of what you're looking at in terms of CapEx and in terms of what you'll be looking at in terms of additional production. But what you may also look at is the historical CapEx as well on a per barrel basis. We'll go into that in a bit more detail shortly. That will give you an indication of whether they're spending more in terms of they're looking at expansionary CapEx or whether they're looking at maintenance CapEx. So maintenance CapEx is just to maintain production. So you're looking at, pardon me, things such as fixing the wellhead, maintaining the processing facility, patching pipelines. Some of those CapEx items will be there as maintenance, support production. It may not support expansion in production, but it'll support you continuing to produce, regardless of whether it's a declining or increasing production rates. But we'll go through that in a little bit. To also take into consideration is the natural decline rate as well. As I mentioned before, an oil and gas well will not produce at the same rates every year until depletion because of the pressures that decline as soon as you pretty much started drilling the assets. Oh, sorry, pardon me, as soon as you start drilling the well. And again, it's good to also bear in mind that if you drill a well and you close it, your production level or your production rate is affected by that because that reservoir pressure is still declining regardless of whether you're producing or not. So your production rate is affected regardless of whether you're producing or not. So when you hear stories of production being shut in or there's sabotage and there's force majeure and the well has to stop producing, the production rates over a longer period of time is affected by that because the longer it's shut in, the gas that's supposed to apply pressure to pump the oil to above ground levels is still pretty much declining. So your production rate is affected by that. I'm just trying to just give some context. It's probably not necessarily applicable for you at this level, but just provide that context as well. But there will be a natural decline rates that you take into consideration, which would help you in terms of your valuation. Because again, management will provide a guidance of CapEx and production for over maybe a 1 year or 2 or 3 year period. You would then apply a natural decline rates of between 5 to 12% to your production levels so that your production is declining, but your reserves is also declining at a stable rate over time until depletion. So that natural decline rate is very, very important.
Can I take 2 questions?
Yes, please.
Okay, one is from, she's asking, is there a benchmark or industry standard for determining the minimum and maximum amount of reserve each company should have?
No, so it all depends on their discovery, which you can say is affected by the size of the acreage that they're operating or searching within. But there's no standard level. I mean, there are oil fields in Nigeria that have 1 billion barrels of oil. There are others with 200 million barrels of oil. It's just, I guess, a function of the area in which you're searching. And I guess an element of luck as well, or the technology and expertise that you have around you as well in terms of searching for that oil. Again, it's also not a perfect science. So often you hear companies that have 2P reserves of 200 million barrels. And as they're drilling a well, they discover that there's more oil than they actually recorded as that 200 million barrels, and it's increased to 220. So those reserves levels are not necessarily stagnant, but there's no standard that the oil company should have.
Okay, the second question, Lukman, is there any standard method or recommended way of assessing the level of reserves? You talked about the risk, technology, etc., being the major determinant factor. How do we arrive at the percentage which will determine if it's 1P, 2P, or 3P?
Okay. So you don't necessarily need to determine what is 1P or 2P or 3P. Management in their financial statements and investor presentations will provide you with their 2P reserves level at the very minimum. They may also expatiate on that and tell you what is 1P, what is 2P, 3P. They may also provide some 2C reserves levels as well. I guess I should have mentioned as well, the reserves at your prospective and contingent can graduate to 2P reserves levels. Again, what changes with that is the level of certainty. So once the exploration activities have been conducted at the prospective level and there's greater certainty on the amounts and commerciality, it can then progress to the contingent level here. What then determines whether it moves from contingent to the commercial reserves level, I guess, is the availability of technology, the viability, so oil prices. So if you look at maybe shale oil in America, maybe 20 years ago, a lot of those reserves could have been in the 2C levels because the technology wasn't available, or it wasn't cost effective, or oil prices were not attractive enough. But if you look at, I think in the middle of the 2010s, when oil prices jumped to 110,000, sorry, 100 barrels, $100 per barrel, a lot of those oil production came on stream, and you saw a significant increase in a lot of those 1P, 2P, and 3P reserve levels. So you won't, as analysts, won't be trying to determine the 2P reserves level and etc. You're pretty much taking it from management as a given, which is why there's that risk of management may be lying or misrepresenting their reserves levels. They try and mitigate this by having an independent, competent party assess those reserves level looking at their geological studies and their findings, and trying to support that and back that as well. But there's always that possibility that those reserves levels are not 100% accurate, which is why you tend to see the movements in reserves levels in terms of the declines and increase regardless of production as well. It's not a perfect science is what I'm trying to say in terms of determining the reserves and the reserves that are reported.
Okay, if you can take one more question. Chibuzo is asking, when should we start applying the natural rate discounts in our forecast?
Okay, great. So I think you would start applying it almost immediately. One thing to okay, so it depends on the level of detail that you have. If management is giving you guidance on the capital expenditure for a 3-year period, you would apply the natural decline rates after that 3-year period, because again, you don't have that much visibility on what CapEx will be and the level of production that will be coming on stream. If they give you for 1 year, you start applying it for 2 years. So it depends on how much guidance management is given. If you have, again, because the incremental or the increase in production is a function of that capital expenditure. If they themselves are not sure on the level of capital expenditure that they're going to be looking at 2 years from now, you yourself cannot necessarily be more sure than they are, more accurate than they are, again, because of that risk of uncertainty. So you work on the guidance that they've provided. One thing that you have is just always that maintenance CapEx there, just support production activities, but you can start to apply that from pretty much when you no longer have visibility in terms of what management will be doing in terms of work program and capital expenditure and incremental production.
Okay, awesome.
Okay, thank you. So just to conclude on the production profile, the other two things to put into perspective as well is downtime. So downtime, as I mentioned before, is a function of those maintenance, breaches, vandalism, sabotage or leakages. So by downtime, what I mean is that production activities will grind to a halt. It may not be all the wells, it may be some of the wells, but production activities will grind to a halt. Now, that doesn't mean that the oil is lost, which is often the case with reconciliation losses. With downtime, it means that you're just not pumping oil from the ground, which is a negative for valuation nonetheless, because the oil is still just left on the ground, but it's not lost. With reconciliation losses, that is more a function of leakages or differences in metering at your production facility and let's say at the terminal. So you look at a company like, okay, I'll use Seplat for example throughout the session because I mean, they're one of the prominent players in the sector. So Seplat, for example, will be pumping oil from its own facilities in the Niger Delta. It will have its meter reading that tells it how much oil is pumping at any given point in time. So let's say at the end of today, Seplat has a meter and its meter said it's produced 10,000 barrels. Now those barrels are sent to the terminal for exportation. However, that pipeline that carries the oil, other operators like Owando, Shoreline and the likes are also inserting their own oil production as well into the pipeline and sending it to the terminal as well for exportation. And there's no way to uniquely identify whose oil it belongs to who, because quite frankly, everything is commingled in that pipeline. There's no tracking of oil or whatever. So what happens is that the oil has different quality levels. By quality levels, some producers may have injected water as a result into the pipelines as well as oil, but their meter is reading its oil as oil. I hope that is making sense so far. So let's say Seplat is inserted 100% oil into the pipeline and sent it to the export terminal. Let's say another oil producer, I don't want to name any names. Let's say another oil producer has inserted oil, but 20% of what it's inserting is also water. There's no way to tell apart who is inserting 100% oil, who's inserting 100% water. But when it gets to the terminal will filter out some of that oil from water and it will relate to the parties that, look, you guys have said that you sent 10,000 barrels of oil into the pipeline, but what we're seeing at our end is 8,000 barrels of oil. What they then do is that they allocate that loss, which is the reconciliation loss. That reconciliation loss, again, is the reconciliation of what the export terminal operator has on their meter compared to what the operator who is pumping the oil into the pipeline has on their meter. That is not necessarily a function of downtime or leakages and etc., but it is a function of differences in meters as a result of commingling different oil or different oil grades or water pumped into pipeline and etc. So that's where you may see reconciliation losses of 5% or 10% come into the equation in terms of production. It can also be as a result of leakages and sabotages as well before they are found that's affected the difference in the metering at the operator and the metering at the terminal. I hope that's somewhat clear. So the difference between downtime and reconciliation loss is that downtime is not necessarily leading to lost barrels of oil, while reconciliation losses is a function of lost barrels of oil as a result of leakages or commingling with different operators. So they're both negative for your valuation, but have different consequences in terms of your production profile. I hope that's clear so far.
I guess so, because new questions coming in now.
Okay, thank you. So moving on to CapEx, or I guess staying on the conversation of assets and CapEx and depletion, as mentioned before, I mean, management will usually provide a guidance in terms of capital expenditure they're expecting. They may divide this by well, actually, no, they often divide it by the wells, and they also provide guidance of how much production you're expecting to see as a result of that. You can divide this and get clarity in terms of what is expansion and what is maintenance. So usually what is the capex leading to incremental production or increase in production is seen as expansionary capex. What is not leading to incremental production is often seen or labeled as maintenance capex. So that's the difference between the two. You can break this down into capex per barrel, which will be very important in terms of your forecasting, because your capex, you can argue, is a function, or your capex is your production is a function of your capex, vice versa to a certain extent. So for example, if a company is spending $5 per barrel on capex, but only $2 of that is usually seen as maintenance, you can say there's some level of expansionary capex. And as you're forecasting your production level, you can forecast the absolute capex level as well. So just bear that in mind, because it's very important, because it's how we're going to forecast the capex beyond the time period that management will provide guidance for. It's also a similar case with depreciation as well. We'll look at depreciation as a per barrel function as well, because depreciation is depreciation and depletion, pardon me. In an oil and gas company, the depletion of the assets is a function of production. If you don't produce, you wouldn't expect to see a depletion of assets. Pardon me, and as the asset I'm referring to is the oil and gas asset that they have recorded on their balance sheet. So what we could do in terms of forecasting depletion and depreciation and amortization is we can look at historical depletion, depreciation amounts and then arrive at a per barrel amount, so that as we're forecasting production, we're then able to forecast what the depreciation in absolute terms could be. So let's say Seplat has a average annual depreciation or depletion charge of $5 per barrel. If we know that if we're forecasting production of 5,000 barrels per day next year, we can assume or forecast that depreciation or depletion will be $25,000 per day next year. So that's a forecasting technique that we'll use, and I'll explain a bit further. But this is really the basic, or the basis, pardon me, of your oil and gas assets forecasting is capex and the depreciation and amortization. And we'll look at both of these as a per barrel calculation and forecasting.
Pardon me if I'm taking you back. I just noticed that there was a direct question sent into my chat. The question is, how is loss shared between the COI concerned?
So I didn't hear the last part. How is
the loss shared between the COI concerned? Okay,
so it's often shared equally, right? Because you're not able to determine who is to blame for, let's say, water entering the pipeline. Often later down the line, it's found out, in most cases, but at the point in time, let's say at the end of the year, you may not have determined who was pumping oil. So it's often allocated equally. Same thing for leakages as well. I mean, if there's a leak in the production pipeline, you're not able to allocate the blame to any operator. It's a function of sabotage or conflicts in the region that's led to the pipeline being the integrity of the pipeline being affected, and we're having leakages as a result of that. So it's often shared equally. There may be cases where a leakage is at a particular point in a pipeline where only one operator has pumped in oil. At that point, that operator will take the majority of that reconciliation loss. So let's say Seplat is pumping oil and the oil is pumped into a pipeline that's a meter away from the major pipeline. Because Seplat is the only company using that stretch of the pipeline and the leak is from that particular pipeline, the reconciliation losses could be allocated to just Seplat as a result of that, because there may not be any other leakages anywhere else in the pipelines. It may just be at Seplat's side, which is what is causing the discrepancy between what's on Seplat's meter and what is on the terminal's meter as what's been sent in. So it's not, again, it's not a perfect science, and unfortunately it's also at risk to being subject to manipulation depending on how close you are to the terminal operator. You may push for lower reconciliation losses and more reconciliation losses are applied to other operators. But one thing to mention is that in the historical financial statements, management will often highlight what their reconciliation losses is like. They will also often highlight what their downtime is like as well. So you can use that to extrapolate what it could be going forward. However, there may be some subtle changes, such as new pipelines coming on stream that may be more secure or underground or less risk to sabotage and breaches and breaking, etc., which may mean that some of your downtime and reconciliation losses may be lower in the future than what they were in the past. So it's very important to take that into consideration as well. So do we have another question, Gloria? I saw someone's hand up.
No.
Okay.
No.
Okay. In terms of the oil and gas assets as well, I mean, just to use an example here, you see that we have the unit capex. Sorry, can you see my? Okay, let me see if I can draw.
Yes, I'm still seeing your screen.
So here you see that we have the unit capex there. This is the calculation going forward. So you see these particularly high capex numbers there as a per barrel basis, we've alluded to as being expansionary capex. Compared to these 2 years here, this 2017 and 2018, I mean, this company, for example, went through quite a bit of unfortunate, it went through a few unfortunate events during this 2016 and 2017, and to some extent 2018 periods as well. A lot of its operations were affected by sabotage in 2016, towards the end of 2016 and some of 2017. So it wasn't really spending in terms of expansionary capex to bring new production on stream, because the terminal at the time was down for a considerable amount of time. So this is where, the capex was mainly focused on maintenance. In this 2016, the early period, there was a substantial amount of capex that was being spent on a per barrel basis, and they continued in they're forecasted to continue in 2019 and 2020 into 2021, before we then start to look at what is maintenance capex in 2023 and 2024. And really, the way that's calculated, that unit capex calculated, as mentioned before, is the total capex divided by the total production for that given year. And that's what we have there as the unit capex. It's also a similar case for the depreciation as well here. On a per barrel basis, you can see it fluctuates quite a bit over the 3 historical years. And also in the recent forecast year, I think this was halfway through the year, it was considerably high. But what you could do is you could take an average of the historical years that you have to help you in terms of forecasting your future depreciation cost on a per barrel basis. That is what we then use to forecast our capex here. Sorry, my cursor is a bit wobbly. Oh, God. So that's what we, so that's what we have here in terms of our capex on a per unit basis. Sorry, on an absolute capex there. So it's the unit capex we have here multiplied by the total production in that year. And it's the same thing as we go into the forecasted period as well. It's a very good and straightforward way of calculating your capex, especially for those years where you don't have guidance from management. And it's the same thing for the depreciation charge for the year here as well. It's really a function of the depreciation unit multiplied by the production for that year. I hope that's somewhat clear.
There's actually a question.
Okay.
David, we calculate the expansionary and maintenance CAPE from the per unit capex.
Sorry, how did we calculate it?
How do we calculate the expansionary and maintenance CAPE from the per unit capex?
Okay, so you have a rough idea. So as I mentioned before, this period here where there was no incremental production, where they were really just trying to maintain production and production activities in 2017, that was a rough estimate that was used to derive this maintenance capex of $2,000 per barrel. This expansionary capex that we have here, or let's say it's not fully expansionary, but you can estimate that there was some expansionary capex in those 2016, 2019, and 2020 because it's substantially higher than what we have here in 2017. For these years, management will provide a guidance on what capex would be, let's say for the 3 years. After that 3-year period where there's not much information in terms of what they plan to do in terms of drilling activities, you can forecast that going forward it will mainly be maintenance capex. Now the maintenance capex, you can look back at historical periods of time to find. So what I did was I found this 2017 as a point in time where there was not necessarily a lot of expansionary activities going on. And I used that as a rough guide of what what maintenance capex could be. So it's really a rough guide is what you're looking for in the historical performance. If there isn't really clarity looking at historical, you can always ask management in terms of what their guidance, what they believe could be in terms of maintenance capex. They often provide that as well in their analysis. Because, for example, if a company tells you it's spending 100 million on capital expenditure, and they tell you that 60 million of that will be on drilling new wells and trying to bring new production on stream, you can assume that that remaining 40 million is for just strictly maintenance. So again, it's not a perfect science. As you probably know from valuation and forecasting, you will be making various assumptions as you go along. But one thing is that is important is that you're able to provide an explanation as to support some of these assumptions that you've made. So, for example, my backing was here in 2017, where there wasn't that much in terms of new production coming on stream, and it's mainly to support activities. We had a maintenance capex level of about 2,400, which is what was used for these future years. In terms of expansionary capex, I remember very well that this company was looking at capex of about $200 million in 2019 and 2020 in terms of its own production to support the new wells coming on stream. So that's what really drove this unit capex here that we have here. I hope that's clear. So it's not a perfect science. I mean, sometimes they may not even divide and give you guidance on what that maintenance expansionary capex is. You would have to look at the historical performance and get a good understanding of where they may or may not have been. Or you can also use a rough estimate as well. For example, in this 2020, where capex was budgeted at about 190 million, you can say 20 to 30% of that will be used for maintenance, and the remaining 70% will be used for expansionary activities. So that way you're able to provide some sort of avenue for you to forecast the future years in terms of the capex levels on a per barrel level to then use to find your absolute capex amounts as well. I hope that's
there was actually, while you were explaining, I'm not sure if it's now clear to Grace. She was saying that it's not so clear. I was asking if you mind going through the calculations again. I don't know if you have time to do that.
Yeah, sure. So I can go back. So this is really the calculation. So for that, this is really the calculation. Sorry, this is the formula. So for that unit capex, that capex per barrel, you're looking at the total capex divided by the total production. That is what gives us our unit capex here. You do the same thing for the depreciation, depletion, and amortization. You take the total depreciation, depletion, amortization, and divide it by the total production. So that's the total amount of oil and gas produced in the year. So the total capex divided by the total production will give you the unit capex, or the capex that's being spent on a per barrel basis. And it's the same thing for the depreciation and amortization. I hope that's a bit clearer.
Okay. One last question from Quadri is asking, how is the unit of production of future years determined?
Okay, great. So that is a function of that natural decline rate. So your production levels are driven by the work program and the budget. So that capital expenditure that management tells you, or probably sometimes doesn't tell you, will then also provide guidance on the production. So management will usually tell you how much they expect to produce in a given year as a result of capex or no capex activities, or expansionary capex activities, or just maintenance capex activities. That is the basis for your production profile in those forecasting years that you have. Management may then not provide any guidance post those 2 to 1 to 3 years, which is where you then assume a natural decline rate, which then affects your production going forward. So for example, if you assume a production decline rate of 10%, that means if you produce 10,000 barrels of oil today, next year you produce 10% less. So next year you'll be producing 9,000 barrels of oil. The next year you'll be producing 8,100, because again, you've reduced it by 10%. And you continue to go down like that until the reserves is fully depleted. I will show an example of the production profile as well in the next few slides. But you would usually forecast the production profile after management has provided guidance, and it's usually a natural decline rate as well. You would also have to incorporate downtime and reconciliation losses as well, but I will go through that as well in the following slides. So this is really, so as I mentioned before, once you have your unit capex and you forecasted your unit capex, same thing for your units depreciation as well. You then multiply those unit amounts by the production that you forecast to arrive at your absolute capex and your absolute depreciation amounts as well. I will go through the production at this point, so that I guess that will answer some of those production questions as well. Just to ask Gloria, is there a particular time for a break so that I can factor that in as well?
I'm going to confirm from Wale.
Okay, great. So just on the, sorry, Gloria.
Okay, I said I'm going to confirm from Wale. I will let you know shortly. Thank you.
So yeah, so on the production profile, and as you rightly asked as well, the production profile is a function of your reserves. So we often start with the reserves level first. That's this table here. So let's say we are forecasting from 2019. So the reserves here will be given by management. These will be your 2P reserves, strictly your 2P reserves. This would be your gross 2P reserves. By gross, I mean we have not taken into consideration the working capital, sorry, the working interest aspect, which is what I think there's someone else drawing. Sorry. Okay, I don't know what's happening. Sorry about the blue lines, I'm not sure. But yeah, so the gross reserves are the total reserves. So for example, let's say a field has reserves of 200 million barrels. That will be the gross reserves. So for a company like Seplat, for example, if it has a 40% working interest, that reserves the amount that it belongs to Seplat as a result of its agreement with the government and its partners will be 40%, and that 40% will be equivalent to 80 million barrels. So the difference between the gross and the working interest is that the gross is the total amount for all the parties that are part of that field or acreage. The working interest is the amount that's allocated just to the specific company. So the working interest amount is really what you'll be using in the valuation, but you would start in most cases with the gross reserves level if it's not provided. If the working interest reserves is provided, you can work with that as well. And from there, you would then determine how much is being produced on an annual basis. So if you have a look here for a Seplat, there was a increase in production here, slight decline here, and an increase here before it starts to decline going into these years. Pardon me. So the decline here, you could say, is a function of maybe significant downtime or disruptions to activities, because as you can see, there's now, let me just use another card. There's now an increase in production levels here. Does that kind of make sense? So this is where you could argue that there's some level of expansionary capex being brought into the system that's driving the production levels. Also, to also put into context as well, the timing of that capex is also very important. So a company may be spending on drilling wells in 2019, but the production does not come into operation until 2020. So you may not see the impact of that capex in 2019 until 2020. So you could argue that maybe the capex, expansion capex maybe stopped here, came into effect here, and the rest of these years were simply maintenance capex. Does that make sense? That these years were mainly just the maintenance capex, because you're seeing production levels decline. Same thing is here, same thing as here. So what drove this production level is, one, guidance from management and their capital expenditure is what really drove this here. And as you can see from the reserves, as the production, as reserve oil is being produced, regardless of the amount, the reserves are declining. So this is the depletion that we've been talking about. The reserves are declining as we go over time because oil is being produced. The more it produces, the more the reserves decline. I hope that's clear so far as well. And really, this is the gross production amount that's allocated to all the parties that's associated with the field or the assets. The working interest, again, as I mentioned before, is what's specific to the company. But what you notice is that the trend will be the exact same. So here, these 2 years here, where you're seeing an increase and then a decrease and then an increase, it follows on from here as well, from the gross, because there is no difference in the trend in production profile. It's just the percentage that's allocated to the company. I'll repeat that again. There's no difference between the trend of the gross production and the working interest production. It's just the percentage split to all the parties that are part of that asset. I hope that's clear. From there, we can then arrive at the total barrels that's being produced on a total basis and on a per barrel basis. So that's that here. This is the amount of oil that's being produced each year, the total amount on a per barrel basis. And I guess that's probably easier to see the trend as well, because as the numbers are smaller, so you can get a better feel for the decline, the increase and the decline. So that's the trend in the working interest production. You would then have to factor in reconciliation losses. In terms of downtime, it's hard to foresee what downtime levels could be in the future. You just look at what it was historically. It's the same thing for reconciliation losses as well. So if you have a look here, historically, it was 10%, then we had 12%, then we had 10%, then we even had some 3% levels. Going into 2019, I believe here it was supposed to increase to 12%. That may be either a function of management being very, very conservative, or you yourself being conservative. Maybe it was an election year and you're expecting conflicts to be higher in the region, so there'll be more losses. But then you notice that they're now declining in 2020, going into 2025. That could be a function of a change in pipeline routes or change in technology. So sometimes management may make some changes to their metering to improve the accuracy of their meter. That can impact on the readings that they're getting and the reconciliation with the terminal operator. In this particular case, I believe the reason why we had a decline in the reconciliation loss is that there was a change in the pipeline. The management was planning to change the pipeline that we're using to export their production to the terminal. So that's what really drove this lower reconciliation losses. To then arrive at this volume sold, we deduct this reconciliation loss from the barrels that we have in terms of working interest production barrels. So your volume sold is your total, or your total annual amount, or your total per barrels per day, multiplied by 1 minus your reconciliation loss amount. So I'll just put that there. P. So just bear with me. Sorry, I hope the writing is a bit readable. So the production, the working interest production you have here is the P multiplied by 1 minus the reconciliation loss we have here. So let's say the reconciliation loss we have is 12%. 1 minus 12%, the resulting amounts there will be 88%. So P times 88% would equal the volume sold. I hope that is a bit clear. I don't know if we have any questions at this point.
No, there are no questions. So I have confirmed, and we will take a short 10 minutes break at 12 o'clock.
Okay.
Is that fine?
Yeah, that's perfectly fine. I think that should
Okay.
take us to, yeah, that should take us to forecasting income statement. Okay. So that's really how you arrive at your volumes to be sold, that we then use to drive your income statements. That volume sold as well would drive your revenues. The volumes that you use for your depreciation and your capex is actually your volumes before the reconciliation losses. Let me just highlight that there. The volumes that you use for your capex and your depreciation is your working interest production level here, because the capex that you're spending is to bring this production on stream, the working interest production. Unfortunately, because of whatever reasons mentioned before, the leakages, other people commingling, adding water and etc., your volume sold will be lower. But the volumes of barrels of oil taken out of the ground is still the same, and that is what you're spending your capex on, and that's what the depletion is on. I hope that's clear. The working interest production is what is coming out of the ground for, let's say, Seplat or Belima or Total. The volume sold is different to your working interest production as a result of that reconciliation loss. I hope that's somewhat clear there. So when we look at this calculation here, we are looking at the actual production, not the production sold. Same thing here. We're looking at P in terms of working that out and then working out the future capex and the future depreciation and depletion. So these units here are a function of the production capex. Your revenues, on the other hand, are a function of this volume sold. So the revenues are a function of working interest after the reconciliation loss. So once we've created this table and worked out what the production is and what the volumes sold are, we usually have a production profile that looks something like this. As you can see, you see the production has gone up where there's been spending, there's been new production being brought on stream, and up until a point of time where either you don't have any more guidance or really there's no new wells to drill, there's no new oil being found, your production level will start to decline. And this is where your natural decline rate comes into play. You see the production looks like a hill. You have the increase, the ramp up in production, and then you have the plateau, and then you have the decline. This is where you see your natural decline rate. Because there's either no more guidance from management, no more wells to be drilled, and production just begins to decline. So that's why it's very important, again, you bring up as much oil as possible in the early years of the assets, because that affects your valuation, because the more oil you've drilled in these periods, the higher the valuation because of the time value of money. If you're drilling more oil in these later years in your valuation, because of time value of money, your valuation will tend to be lower than if you had drilled more in this time period. And that's where I guess the factor of downtime also comes into play as well. So Gloria, do you have any questions at this point?
No, there are no questions.
Okay, so I hope this part on production is clear. You start with your reserves to then determine the production levels, because once you get to a point where there's no more reserves, there's no more production. So that's why you always start at your reserves level. You probably be thinking you can just start with production, but usually as you go down the timeline, you see that you run out of reserves and you can't have production without reserves. So that's why you usually start with your reserves level and work into your production. And then from your production, gross production amounts, you can then determine what is the working interest to separate. In some cases, you may already have your working interest reserves, and you can start with your working interest reserves, go into your working interest production, and then you can then incorporate your reconciliation loss to then arrive at your volume sold. But always remember that this working interest production amount is what is driving your absolute capex in the future years, as well as your depreciation and amortization as well. I think this may be a good point to stop the income statement forecasting before we go on a break.
Okay.
As if we don't have any questions.
There are no questions currently. If anybody has a question, you want to raise your hand so I unmute you to speak. Maybe we can take one question before we go on the break.
Okay.
I'm checking. Okay, so LC is asking, can we go over how the working interest production is determined from gross reserve, gross production?
Yeah, sure. So this gross reserve, so you would, let's say we are forecasting 2021 onwards. So, pardon me, let's say we're forecasting 2018 onwards. This 2018 reserves level will be given by the company. They will tell you this is our reserves 2P. Again, I'll highlight 2P reserves at the end of 2018. Great. You would then use that as your starting point. You would deduct your this year's, pardon me, your starting reserves minus your production equals your reserves at the end of the year, which is then brought forward to 2019. I hope that's kind of clear. So I'm trying to see if I can get a blank piece of paper. So your brought down reserves, minus your production equals your reserves carried down, or your closing balance, which is here. So this reserves levels minus your production in 2019 equals your closing reserves level in 2019. Now, this production level that you had in 2019 is a function of guidance from management, or because it's your first forecast year, you usually have guidance from management. If not, it will be a function of your natural decline rate. So this 2019 could be 90% of this 2018 if you're using a 10% natural decline rate. If you were given guidance by management that production was going to increase by 3,000 barrels per day next year, obviously there would then be an increase in this production level here. But if it's a case of there's no more capital expenditure, you're just looking at maintenance, there will be a natural decline. So there will be a 10% decline here another 10% decline in 2020, 2021 onwards until your reserves are fully depleted, as we can see at this point here. This point, this blue bar here is the reserve. So as you can see, as you're producing, the reserves is declining. And 2024, is that 24? Sorry, 2042, there are no more reserves left. So at this point, you've arrived at your production. It may be your gross production level. You then arrive at your working interest production by multiplying the interest that the company has in that asset. So for example, if Seplat has 40% interest in this particular OML 438 and 41, it will be 40% multiplied by this gross production to arrive at this working interest production level. So your gross production, sorry, your working interest production is your working interest multiplied by the gross production. From there, you now have your working interest production. That's your production, is what you use to forecast absolute capex amounts where management is no longer given any guidance, as well as your depreciation charges as well, depreciation and depletion. To arrive at your volume sold, you take into consideration your reconciliation loss. So that's why we have this formula here. That working interest production is the P multiplied by 1 minus reconciliation loss to arrive at the volume sold. So as I mentioned, for example, the reconciliation loss is 12%. That 1 minus 12% will give you 88%. So you still have 88% of your production to sell after it's gone through the pipeline and there's been theft and etc. So your working interest minus your reconciliation loss equals your volume sold. I hope that's a bit clearer.
Yes, so Ayo, there is a question. I guess we can take this one last one before we go on the break.
Okay.
Is that fine?
Yes, please. No, that's fine.
Okay. Is reserve not a function of technology that is available at the point in time? So could that curve change as technology improves?
Oh yes, most definitely. So this production profile and reserve profile is at the point in time you're doing the valuation. However, next year, if there's an increase in reserves due to new discovery or changes in technology or high oil prices that's now allowed some of the previous contingent reserves to be commercially viable, you will see an increase in those reserves. So you can even argue even some of these early periods here where the line is somewhat volatile. You can see that the reserves jumped from 2014 to 2015 here. It's either they acquired an asset here, acquired a new license, or there was a change in reserve level or technology or etc. that drove that there. You see there was a decline here, but every year after that, there was an increase. So it's a case of despite the production levels that we're seeing increasing here, reserves were also increasing. But at this particular point in time that we are here in this 2019, because we can't see into the future into what's going to happen with reserves, we're assuming that reserves is just continuously depleted and there's no additions. Again, it goes back to that assumption that there's no explorational activities, there's no additions to reserves, because it's a very subjective aspect, and to be honest, it's very technical, and at this stage, we don't really have the know-how to determine how reserves may change in the future. It's really on a going basis that you see changes in reserves.
Okay, thank you very much. I think we can go on that short 10-minute break and regroup at 12:15.
Okay. I will try and drop a table as well, just to explain the movement in reserves and production as well. But yes, we can end at 12:15.
Okay, yes, but like the call would be ongoing. I'll just sign and anybody wants to stay online is free to do so. We'll just start again at 12:15. Thank you very much.
Thank you. So this is, I guess, a simplified version of the table I was trying to show earlier. So here we have the opening reserves. Like I mentioned, this will be provided by the company that you're looking at, usually in their financial statements. The production, let's say 2018 and 2019 is given, and you're looking at an increase in production here. But production starts to decline in the following years. As you can see, there's a natural decline rate there. There's a decline in production levels here. You could say that this should have actually been if we had done a 10% decline rate here, it would have been 3.6, which is in excess of what we have in reserves. Again, because reserves drives production, as I mentioned before. So the maximum you can produce here is this 3,000 that you have in reserves. So this is where the calculations now start to come in. Your working interest production is the gross production multiplied by the percentage you have as interest in the asset or the field. It's pretty much constant regardless of how much you're producing. That 40% is constant, as you can see there. Now that reconciliation loss that I mentioned as well before, let's say it's 10%. It's 10% of that working interest production. So in 2018, it's 120. In 2019, it's 160, and 2020 it falls to 120 again. Now the volume sold is the difference between, pardon me, should be here. Volume sold is the difference between that working interest production for the company and its reconciliation loss here. Now your closing reserves, on the other hand, is based on, again, this is gross, is based on the difference between the production, not the working interest production, because again, you're looking at gross levels. You're looking at the gross level production as well as gross level reserves. That's the closing reserves. The opening for the next year is last year's closing, and it's the same thing going over. So I hope this kind of helps to paint a better picture of the reserves and production profile, because it's very important when we're then going into the income statement and balance sheet. Are there any questions?
So far, no.
So I'll just switch back to the slides.
Okay, just Lukman saying thank you very much. So I want to check that as it's clear.
Okay, great.
LC is sorry, decline rate 90%.
Oh, pardon me. So if we go back to that other screen. So the decline rate is really 10%, pardon me, not 9%. It's 10%. So for example, if we had larger reserves, for example, let's turn this into 20,000. So let's say there's no more expansion capital and you expect production to start declining. You will do this. So as you can see, your production is declining at a 90% rate. So I can show you the change. So it's declined at 10% rate, and it goes on there. So you can actually just drag this across. I haven't put in the correct formulas, the if statements, but as you can see, it will just keep declining. Your reserves will keep declining until a point where it reaches 0. And that's really what you're trying to create, is that profile that would then feed into your income statement and will drive your balance sheet and the likes. If you have the working interest reserves, then you don't need to calculate working interest production. You don't need to be worrying about this production gross line, all these gross lines. You just be here at working interest reserves, working interest production, the reconciliation loss, volume sold, and then the closing reserves. I will also share this as well, this Excel, so that it's, I guess, something you can have handy to help us as well. So going back to the slides. So we'll now move to the income statement forecasting. And this is when things get a bit more familiar and I guess a bit more easier as well. So from here onwards, you're now looking at pretty much familiarity in terms of the standard DCF. There just may be a few lines that are a bit different. So in terms of income statement, there will be fiscal terms that will be governing the assets. So for example, in oil and gas, there are royalties, levies, and taxes that are different from your standard operating company. So in Nigeria, for example, royalties range from 7% to as high as 20% currently for oil and gas production. There are taxes that range from 50 all the way up to 85%, pardon me, from 30 all the way to 85%. And then there are levies, one that you may or may not be familiar with, the Niger Delta levy, the Niger Delta Development Commission levy, which is a 3% levy on operating and capital expenditure. But we'll go through that in a bit more detail going forward. Your revenue, just to start with, is a function of the oil price and the production or the volume sold. Let me just put that as.
Please let me know when you can take a question. There is one in the chat box.
Okay. So you said there's a question?
Yes, please.
Okay. So you wouldn't necessarily incorporate that into your analysis, right? Because as part of your forecasting and analysis, you prefer to have a greater amount of certainty than management just saying they expect reserves to increase. Usually management will always expect reserves to increase, or they will indicate that we expect some of the 2C reserves to be converted into 2P reserves in the future. That's something you would pretty much hear frequently, but you would use that in your discussion, but not necessarily your valuation, because you don't know the timing of that to incorporate into your valuation. So even in the statements you made, reserves to increase in the future, foreseeable future, great, but when in the future? Because that will impact your valuation. If you, for example, had incorporated that next year, but it's actually in 4 years' time, your valuation would be a lot higher than it probably would have been if it really did come in 4 years' time than in the 1 year. So you would need a bit more certainty before you start incorporating the reserves numbers into your forecast and your valuation. I hope that's clear. So moving on, in terms of the income statement, so the revenue is a function of the oil price, production, and volume sold. Your direct cost, again, is a function of production, and there may be levies as well that come into that consideration, which to a certain extent are also a function of production, but it's not always the case. Your indirect cost of production, on the other hand, are not necessarily driven by production, but necessary for your operations. So those are things like your head office, your selling and general administrative costs, some of the transportation costs for your staff, some of the technological costs for running your head office, security, things of that nature. Security may or may not be a direct cost element side of things, but they're usually indirect cost of production line items. Your finance, income, and cost, those are relatively straightforward and largely in line with your conventional calculations. But unfortunately, tax is very complicated with oil and gas companies. And I'll explain why as we go forward. In terms of oil price and revenue, your revenue is a function of your annual production or volume sold multiplied by the average realized oil price. Your oil price, okay, so I guess there's a point to make here, the realized oil price. So the oil price that you have maybe from Bloomberg, Capital IQ, or some of the other websites may not necessarily be the realized price for the company. By that I mean the oil price that we see on Bloomberg, etc., may differ from what the company is selling at because of things like hedging, commissions, and payments to middlemen. We'll have a look through now on how to calculate that, but I just wanted to make that point. Your oil price in the global markets may not necessarily be the realized oil price. The difference may not be much. It may be like 1 or 2% or 3% in some cases, but it's good to indicate that it may not necessarily be the same. In terms of the oil price you would use, you could use the spot oil price for your valuation. You could use scenarios, for example. Now that we have oil prices at $80 a barrel, you can question how sustainable that is. So you may say, okay, my base case is oil prices at $50 or $60. My bull case is that we see oil price at $80 or $90. My bear case, you see oil price at $40. This is what my valuation is at those different oil price points. So that's one way to I guess, add a little bit of flavor to your presentation and to your valuation as well, given that you're considering different scenarios and highlighting what may drive some of those scenarios, and not just taking what we have as spot price now or what we have as analyst consensus going forward as well. For gas prices, I mean, gas prices in Nigeria are fixed in long-term contracts and adjusted for inflation. So it's a bit different from oil prices and gas prices in the global space. So it's just one thing to bear in mind for future reference. So here, as you can see, just a continuation of where we were before. The revenues here are a function of the realized average oil price here, multiplied by the production levels that we had earlier above in the above tables. So you see here where I have this average Brent oil price. That was taken from Bloomberg as the average Brent price for that year, and as well as forecast for the going years going forward. But what you see is that it wasn't always in line with Seplat's realized oil price. So this realized oil price is basically the previous year's revenues divided by the volume sold. I repeat that again. The realized oil price is, for historical years, is revenues divided by total volume sold. This is how we arrive at some of these realized oil price numbers here. That differs from the historical average Brent oil prices we have here. But the difference is not much. Like I said before, if you have a look, the ratio of realized oil price to average price is about 97, 96%. So the difference is about 3 to 5% in some cases. You can take an average and say, okay, realized oil price is about 96% of what it is in the global markets. And you can apply that going forward. So for example, in the forecast of the average oil price here, we see it's 64, 61, 62. But for Seplat, we've put it as 58, 59, 59, 60 going forward, because we've multiplied this realized oil price to average oil price ratio and multiplied it by the average oil price to arrive at the realized oil price for Seplat. This realized oil price is then multiplied by production to allow you to arrive at this revenue number here. I hope that's kind of clear. I don't see any questions.
No, there are no questions right now.
Okay, so that's how we arrive at one, our realized oil price, and two, how we arrive at our revenue. It's the same thing for gas as well. It's just that gas prices, there's no realized gas price. You just use the gas price. Okay, not clear. So which part is not clear specifically, please? Okay, maybe I'll just run through it again. So in the global oil markets, you have the average Brent oil price. That does not necessarily mean that you're selling at that price, because there are often costs that you have that you pay to middlemen, commissions and etc. There may be hedging that you have in place as well. So your realized oil price, that is your total revenue divided by your total volume sold, may not be equal to the average Brent oil price in the global market. That difference is often 3 to 5%. For Seplat, at this point, it was 3 to 5%. So going forward, you discount the global oil price forecast for that 3 to 5% to arrive at your own realized oil price forecast, which you then multiply by your volume sold to arrive at your revenue. I hope that's a bit clearer. Okay.
So there is no response from Chibuzo.
Okay. So I'll move on to your cost lines. So in terms of direct production cost, there are cash costs and then there are non-cash costs. So for example, as you probably understand, your depreciation is not a cash cost item. It's just it's a non-cash item. Let's put it that way for simplicity's sake, but it's linked directly to your production levels, because we calculated that unit depreciation and amortization cost line to drive our total depreciation amount. So because of that, depreciation will be dependent on volume, which, if you think about it, makes sense, because the more you produce, the more is being depleted from reserves. Therefore, the lower your asset value should be going forward. Your transportation and handling cost, that one is also driven by production, because there is a cost per barrel associated with transporting your oil from the pipeline to the terminal, which is when it's then exported. your rig related costs. So your rig is the tool that's used to drill the well to bring the oil to the surface. That is also driven by production levels. And what you see is that it's often higher where there's a lot of drilling activities, a lot of expansionary activities. It's the same thing for the operational and maintenance cost as well. They tend to be higher during times of drilling activities or sabotage or theft like that, because you're having to patch and repair and all the rest. The other line items are your royalties and your levies. As you would expect, those are also driven by production, because as I mentioned, you pay 20% of your 7 to 20% of your revenues as royalties, which again, revenues driven by production. So as a result, your royalties will be driven by production as well. So just now kind of give an illustration of that. You see here, we have the transportation, which is the crude handling charge here. You see we have operating maintenance costs here. We have rig related costs here. We have royalties here, and we have the Niger Delta levy here as well. Those are your key direct cost of production for this company. I mean, you may also see some other line items as well. What we have done here is that we have looked at the historical averages on a per barrel basis. So you see that royalties here, we've divided it by the volumes sold, because royalties is, sorry, the revenues, pardon me. Royalties is a function of revenues and is a function of a per barrel and etc. So here you see that your royalties has always been about 19, 18, 17% as a result. So you can use that to forecast your future years, that royalties will be 17 or 18% of revenues going forward. So you use that to forecast your revenue line here. It's a similar case for your Niger Delta Development Commission levy as well. It will be driven by your sales. As you can see here, it's a bit more volatile, but you can see that it's about 1% of your revenues. So you can use that to drive your, Niger Delta Commission levy going forward. In terms of your rig-related cost and your operational and maintenance cost, you see a bit more of a different trend. You see that here, your rig-related costs are quite volatile. And there's a reason for that. So your rig-related costs are your costs associated with drilling and drilling and bringing oil to the surface. So in the years where you're a bit more capital intensive and you're bringing on new wells and new production, you see that your rig-related costs on a per barrel basis will be higher. But then you notice in 2018, 2017 is lower. And if you remember earlier, I mentioned that there were some disruptive activities that reduced your expansionary activities during those years, new wells being brought on stream. That is when your rig-related costs declined. So going forward, you can't necessarily just assume an average of the previous years. It would have to be in relation to those years where you believe there will be a lot of drilling activities and a lot of new oil being brought onto production. So if you have a look, those years where we initially assumed that there were high capital expenditure levels, so this 2019, 2020, and 2021 are really where there's high rig-related cost on a per barrel basis. On the years after, they decline, and eventually they're about 0.1 dollars per barrel. And it's in direct relation to your capital expenditure levels as well. For crude handling charge, I mean, that you can take a historical average, quite frankly. It doesn't necessarily change that quickly or that easily. It can change when there are changes to pipelines routes. So I believe that's what drove this decline here, the potential switch in alternative pipelines, which is a bit cheaper. That's what drove that switch here. So once you have your per unit or your percentage of revenues for your cost lines historically, you can then use that to drive your indirect cost line items here. So I guess this is where, the modeling becomes a bit more familiar with your standard DCF and your standard companies, your manufacturers, and etc. Moving on to indirect cost. These are the cost items that are not directly a function of your production, but for forecasting methods, you would use a percentage of revenues in most cases. So things like your employee benefits, salaries and compensation and the likes, consulting fees, and other operating expenses, you would use revenue to drive those. The non-cash items as well, the depreciation and amortization, we already have that. You may find that some other assets, other than the oil and gas assets, are also being depreciated, but you can work that out from the balance sheet calculations we'll see shortly as well. But I think this part is pretty straightforward. The indirect cost lines items are pretty straightforward and easy to derive. And we see that here, the depreciation and amortization is taken from the balance sheet as highlighted here, whilst the other line items, such as your employee benefits, your professional and etc., they're all a function of your revenues. So you look at the historical and you project for the future based on the average in most cases. You can apply some subjective elements to it. You can consider inflation, for example, going forward. You can consider increase in headcount if you wanted to, but these are more straightforward forecasting lines than, I guess, your production profile reserves were. Now, in terms of your finance income and finance costs, those are also very similar to your traditional companies. I added this unwinding of the discounts there. It's really just for context so that when you see it in the financial statements, you're not thrown off. I wouldn't like to go through this now because it's quite technical and can be very complicated very easily. So I would say it's best to just leave that on the side for now. In the balance sheet, you see decommissioning cost or provision for the decommissioning cost. You can keep that as a constant. Really, it doesn't affect your valuation, to be honest, because it's a non-cash item. So you can keep that pretty stable. In terms of your finance income, you can look at your average cash balance and multiply it by the implied interest rates, looking at historical levels, of course. It's a similar thing for your finance costs, looking at interest on borrowings as a basis or as a function of the average debt multiplied by the implicit or implied cost of debt. Again, looking at the historical interest to debt levels to arrive at your implied cost of debt. But I think this will probably be quite familiar in your conventional manufacturer and etc. So it shouldn't be too far-fetched. In terms of tax rate, this is where it's a bit complicated again, and we can end up spending 5 hours trying to understand the tax rates and capital allowances, and I don't think it would be really worthwhile at this stage. But just for context, I've put in some stories here. So in Nigeria, we have what you call joint venture and we have production sharing contracts. They have different tax rates that apply to both. Gas as well has a different tax rate. Gas has a tax rate of 30%, which again complicates matters. To complicate matters even further, those tax rates are not actually what is always paid, because some companies may have tax pioneer status. So for example, a Seplat had a tax pioneer status of 5 years, which I believe was between 2010 up until 2015 or 16, I believe. So it wasn't liable to pay any tax despite this tax rate. So you didn't see a tax rate, you didn't see tax on its balance sheet, or in most cases you saw a tax receivable on its income statement. So it was accruing deferred tax in some of those earlier years. There's also capital allowances and tax credits as well, because it's such a capital intensive industry. Lawmakers give oil and gas company allowances to claw back some of those capital expenditure lines in some of their tax liabilities. There's also the case of significant deferred taxes as well. So all this is trying to say is that trying to find your implied tax rate or implicit tax rate or effective tax rates can be very difficult. You could look at the historical implied tax rates for more matured companies. That would be helpful because they've stabilized. There's not that volatility in capital expenditure and allowances and etc. So you can look at the historical implied tax rates there. For newer companies with often very high amounts of tax credits and investments being clawed back, it would be very volatile. So I would advise looking at the historical tax rates, implied tax rates as a guidance for that. You can also always just use assumption of where you believe could be going forward. But often these tax rates of 50 to 85% are not often the implied tax rates. And from there, really, you can see here we have the forecast for the income statements over a 10-year period, just following those guidelines. So if you see some of these more subjective line items, you see they were not forecasted. So your impairment on financial assets, your fair value gain or loss, your other income and losses, those were not forecasted because they're very subjective. But the rest of them, you can say you were able to drive and derive using some of the methods highlighted previously to arrive at this, your income statement forecast. I know I've only shown you 10 years here, but I'll explain why shortly. We're still looking at a full depletion, but I think, as I mentioned before, the level of accuracy you have declines over the length of the forecast period. So I don't think there's that much of an advantage forecasting all these individual lines over a 30, 40-year period that your assets may have until this full depletion. So I only did 10 years here, and I'll show you what I did with the free cash flow forecasting later in the slides. Do we have any questions on the income statement forecasting so far?
So far, no question. Yeah.
Okay. So looking at balance sheet forecasting, I think the most difficult and most challenging part was this oil and gas assets. which was the function of the oil and gas capex and the depletion, depreciation, and amortization lines. And I guarantee you that's as difficult as it gets and as complicated as it gets with the balance sheet. All your other line items you can do in the conventional manner. So things like your trade payables, receivables, your inventories, your loans and borrowings, you can do in the same manner as you would your manufacturing company or your consumer goods company. You could use a percentage of sales, cost of sales, which I'll show you now. Yes. So if you look at the other property, plant, and equipment, so these are the ones that are aside from the oil and gas assets. So these are your buildings, these are your cars, your standard assets, basically. They are a function of your balance brought down minus your depreciation plus your capex. Your depreciation is your effective depreciation multiplied by the brought down balance and the capex, the historical levels, that is. And that's what you really use to drive your depreciation. Your capex, you could look at historical capex levels as a percentage of the amount brought down. So, for example, it could be that 2% of brought down capex is added each year, and you can use that to forecast capex going forward on an annual basis. For your prepayments, inventories, receivables, and payables, you're basically using days turnover of payables or a percentage of your cost of sales or revenues to forecast going forward. So you look at the historical percentage of cost of sales, for example, for inventories, your historical percentage of revenues for receivables, your historical percentage of cost of sales for payables, and use that to forecast your cost of sales going forward. And I believe that's very similar to your consumer goods and your manufacturing companies and the likes. And that's really pretty much how you arrive at your balance sheet. You see that there are some other line items here. My advice is, for the sake of complications, you leave that constant. Obviously, your cash balance is not constant. It's a function of your cash flow statement, which we'll go through shortly. It's the same thing for your share capital. It's pretty constant. Your share premium is pretty constant, but you notice your return earnings is not constant. Again, that is a function of your profit after tax in your income statements and the amount of dividends that you're paying. I didn't go into too much detail on this because I think it follows the same standard as your regular consumer and manufacturing goods company. These other lines, such as your current liabilities, other current liabilities, you see I've kept it relatively constant as well. Those are not your so-called important line items. Your trade royalties and accruals payables, that's been derived using a percentage of cost of goods or your other operating expenditure. Same thing for your inventories and your receivables and the likes. This, your oil and gas properties, we've discussed that earlier, is derived as a function of the oil and gas capex and the depreciation, depletion, and amortization. And I think that's really the difficult part in the balance sheet forecasting. Everything else is a bit more familiar going forward. The line item that I said you will see that is a bit confusing is this provision for decommissioning cost. It's quite complicated, so I don't want to go through it in this session, but it's something that could be easily picked up in the future. But I would for the case of your evaluation, I would hold that as a constant over the valuation forecast. Do we have any questions on the balance sheets? I know I'm going through the balance sheet quite quickly because there's not much difference for oil and gas company and your manufacturing or consumer goods company. So I don't want to spend too much time on that.
No, there are no questions.
Okay. With your cash flow statement, it's pretty much, again, the same as your standard manufacturer or consumer goods company. You see the line items are pretty familiar. You have your cash from investing activities, which is really just your capex and investments in oil and gas property or your PPE. You have your financing, which is a function of your dividends paid, received, and any interest you've paid as well on your debt financing. And you have your cash flow from operating activities, which is pretty much your profit after tax being adjusted for depreciation, working capital, and etc. Basically your non-cash items. And if you look at the cash flow statement, and as mentioned before, it's really just reconciling the change in balance sheet from one year to another. So the change in balance sheet between 2018 and 2019 is what you see a lot of these line items as being. They're really just reflecting changes in balance sheet in most cases. And this cash and cash equivalents here brought down, this 369,503 is what is then shown in your balance sheet for 2019. Let me just here. Just again, just to highlight how everything is linked. That's the number we have here. If your balance sheet doesn't balance, in most cases, you may not have captured everything that has changed in your balance sheet in your cash flow statement, because the cash and cash equivalent is the figure that reconciles everything from the cash flow to the balance sheet. So it's very important to make sure you've captured all the changes in your balance sheet here in your cash flow statement. Now, this is where things get a bit more interesting. This is your free cash flow forecast that you will use to discount back to arrive at your valuation. Now, you see that all these line items, there's nothing new here. They've all been taken from your income statement and your cash flow statements in some cases. So you have a look here. We have your revenues. This is just taken from what you forecasted in your income statement. You have your, sorry, pardon me, your revenues here as well. So this is your oil revenue, gas revenues, oil revenues. You see we have your EBITDA here. Again, this is taken from your income statement above. You see we have the change in working capital here. This is taken from your cash flow statement. We then arrive at the operating cash flow line here, which is just a function of this. It's a function of your EBITDA plus your working capital, plus your change in working capital, pardon me. The share of joint venture dividends, that's a line item I had specifically for a joint venture the company was looking at. It may not be applicable for you in terms of your own valuation. The capex we have here was taken from the cash flow statement. And the tax payable we have here was also taken from the cash flow statement we have here. Okay, so let me just answer this.
There is a question. Can I call it out?
Yes, please.
Okay, so I'm sort of lost. If there's not much difference concerning the balance sheet, can we forecast items using this technique with previously forecasted revenues and costs?
Yes, you can. So that's exactly what I did here that I was trying to highlight here. So if you have a look at this particular slide, you're pretty much forecasting your prepayments, inventories, receivables, and payables using that days technique. I just use the percentage because it's a bit more simpler or easier, but you can use the days technique if you're comfortable with that as well. So that's really for these current assets and current liability lines. You can't use it obviously for your PPE and your oil and gas assets, because if you remember, your oil and gas assets is specifically driven by the capex for the oil and gas operation and the depletion and depreciation as well, which is calculated on a per unit basis to then forecast the absolute amount going forward. So to your question, yes, you can use that for those that there isn't much difference in terms of balance sheets line items. So your current assets and current liability lines are very straightforward in that sense. So back to this free cash flow forecast. You see, we now arrive after taking out line items from above. The calculation is basically your revenues. You get to your EBITDA. You don't really have to have your revenues, but I just like to have it there because it's a function that you use going forward. And I'll explain why shortly. So your EBITDA plus your change in working capital equals your operating cash flow minus your capex and your tax payable equals your free cash flow. This is the line item you'll be discounting back. So you need to forecast this all the way down to depletion. But you remember when I said earlier that there isn't much benefit to forecasting your cash flow statement, your balance sheet, and your income statement for the whole entire life, because it's very time consuming and it's not really worthwhile. Once you've done about 5 or maybe 10 years, you can now extrapolate, you can now use that to forecast your future years all the way down to depletion. So keep an eye out on this. This is the 10-year, but after this 2028 period, we now have this. So after 2028, you see that I don't actually have all those major line items forecasted. What I have here is that, you know, we have the production profile forecasted all the way down to depletion. Very, very important. That's the only one you need to really forecast in all the way down to depletion. Your revenue line, for example, is a function of the average revenue multiplied by the production line. You see that it's kept relatively constant for oil price here. After your 2028 period is kept constant here. For gas is also constant, to be honest, as well. So what you've done there is that after the 10-year period, you've kept your average revenue per unit the same. So you're just multiplying your average revenue per unit by your production to arrive at your revenue line here. What you then do to arrive at your EBITDA is that you hold that EBITDA margin constant until depletion. See, if you have a look, that is also, apologies for the squiggly lines. I can't draw a straight line on the laptop. You see that here, we have EBITDA as a percentage of revenues, which is why we're still forecasting revenues at this point, because we need it for all the line items below. Your EBITDA as a function of revenue is just your EBITDA margin. That is kept constant after 2028 to arrive at your EBITDA here, because you just multiply your EBITDA margin by your revenue to arrive at your EBITDA. Instead, again, of forecasting each of the cost line items individually, which again is very time consuming, not very accurate anyways, so it's just not beneficial. You now arrive at your working capital line. Again, once you get to 2018 or a year that you're comfortable with, it's kept relatively the same as a function again of your revenues. So the change in working capital as a percentage of revenues is then constant. To arrive at your change in working capital, you just apply that ratio to your revenues. Again, the revenues is the most important line for building out this model till depletion. For CapEx as well, we keep that 6.6%, that percentage of revenues constant again. Again, it's very time consuming to be forecasting CapEx. You can maintain that unit production function there and continue to multiply that unit of CapEx to the production level. But I just found this to be a bit more simpler, and it's just easier to explain as well. So CapEx as a percentage of revenue is constant until depletion. So you see, as your revenues is falling, which again, you remember is a function of production. So the only thing that's changing now is just your production, because your revenue per barrel is constant. So your CapEx is just declining with your production levels to depletion. It's the same thing for your tax payable, except for your tax payable is a function of your EBITDA rather than your revenue. So it's kept constant again here at 24.4%. That 24.4% is multiplied by the EBITDA you have here to arrive at your tax payable. And what you've pretty much just done there is calculated the free cash flow all the way down to depletion. And you're now ready to discount everything back to present value. I just want to just pause there to see if we have any questions or...
No, we don't have any questions so far.
So at this point, you've pretty much forecasted your oil and gas reserves to depletion, and you now have a free cash flow forecast for your oil and gas reserves to depletion. If I was to draw a graph showing this free cash flow, you see it would be very similar to this. It'd be very similar to this production profile, because again, your reserves and your production is what's driving your revenue, all of your direct costs, and it's also playing a part in some of your indirect costs as well. So your free cash flow will also follow this arch as well. So that's why, again, it's very important that an oil company is producing as much of those reserves as early as possible, because that's what really drives the valuation. If this oil and gas company was producing more of its reserves in the later years than the earlier years, its free cash flows will be lower in the early years and higher in the later years. And its valuation will be less because of time value of money. So that time value of money is a very important factor. And that production profile is a very important factor in terms of driving that valuation of the company. Let's take us back to where we left off. And pretty much there you have it. You've created your free cash flow forecast. Now is to discount. Unfortunately, the discount rate you choose is not that straightforward. In your standard DCF, I mean, you calculate a WACC, which would be a function of your equity, cost of equity, your cost of debt, your after-tax cost of debt, your weightings, and etc. But with oil and gas, there's a standard 10% that is always used. And I've tried to capture that story in this slide here. So because SEC, the US SEC requires publicly traded companies to release a summary reserves report, and it always uses a 10% as a present value, a discount rate for present value. That 10% is seen as a global benchmark. It's not always accurate. I mean, your cost of capital can be lower than that. It can be higher than that. But it's seen as a benchmark. And I guess it helps with comparability as well for companies going across the board. For you and for myself, I take that 10% and I adjust it upwards or downwards for country or company specific risk. So for a company in Nigeria, I used 15% just to take into consideration all those risks in the Niger Delta of explosions and sabotage, company risk, things like corporate governance and etc. And I used 15%. You may choose to use 12%, you may choose to use 15%. But I think one thing that will be very important is that maybe you provide a sensitivity analysis. So it just shows the difference in your valuation for different discount rates. It provides a bit more comfort, I guess, rather than just using one and saying this is the only discount rate I've taken in consideration. You can decide to use create a sensitivity analysis that just shows how that valuation will change using different discount rates. So with that discount rate, you will now discount your free cash flows you forecasted from, let's say, 2018 down to this 2042 that we have here. That will give you what we have here as the sum of present value of cash flow, or your valuation of the 2P reserves. To arrive at this, our target price here, oops, at the very bottom, once we have that present value valuation, it pretty much follows the same standard as your DCF. You take away your net debt to arrive at your equity value, divided by the number of shares to arrive at your individual share price, target share price. Because maybe your financial statements are in dollars or Naira and the company's share price is traded in a different currency, maybe it's traded in pounds or it's traded in, I don't know, yen or South African rand, you may choose to adjust that target price for spot rates as well, so that you're able to arrive at a comparable target price in the same currency as the stock is traded, to then arrive at your buy, sell, hold recommendation. So that really is your modified DCF valuation method. It starts off a bit complicated, but as you go through that reserves and production profile side of things, it becomes very familiar very quickly. So I just want to pause here and just maybe take any questions before we look at the relative valuation methods.
So there are currently no questions in the chat box.
Okay, great. So just briefly, just look at the relative valuation methods that you could also look at. There are mainly four that are often used in oil and gas. They have different implications, so therefore they have different meanings and different uses. Your enterprise value to 2P reserves, you often use that when there is not that much information or details on the cost lines and assumptions in terms of maybe oil price or cost lines or capital expenditure, but you want to have a rough idea of the valuation of those reserves. You would look to use the EV to 2P reserves multiple. It's a similar thing for the EV to barrels of production per day as well. It's a case of not always having a full grasp of the assumptions on the cost lines and depreciation of the company. In terms of the EV, EBITDA, and the price to cash flow, those are used when you have a bit more detail on the company itself, some of its cost lines, capital expenditure, the timing of when reserves will be depleted, when production will come on stream, all the granular details that we went through in the modeling previously. That's where you would look at some of these ratios. The reason is because you'll be comparing it to other companies that have a similar cost profile in most cases, because onshore and offshore assets have different cost lines, cost profiles, and capital intensity. So it's always good to try and compare onshore oil producing companies with onshore and offshore with offshore oil producing companies as well. And it's the same thing for the price to cash flow. It just has its benefits of being less susceptible to manipulation because it doesn't, it strips out all the non-cash items. It's just that with the share price, what you often have is that the share price is susceptible to changes in oil price because most investors and market participants, when oil prices are declining, they tend to sell off on oil stocks and buy oil stocks when oil prices are rising. So that tends to affect the multiple. So it's one thing to bear in mind there. And lastly, I've just added some metrics that you could use in terms of discussing companies and comparing companies as well. They are somewhat self-explanatory and some things that we've gone through in the above discussion. So I won't go into too much details here. But this could be useful in terms of your write-up and your comparison into why, you know, two companies have different valuations and they operate in the same terrain, in the same country, maybe even in the same field or the same assets. So yeah, so that would be all, I guess, on oil and gas valuation, and I hope it's been insightful and helpful. And I would probably take questions here, but I mean, we've been taking questions. So I don't know if there's any other questions.
Yeah. So thank you very much, AJ. There is no question here, but I would like to just throw it open. If any of the participants have any question, you can actually use the raise hand feature and I would unmute you to ask your question. Or you can drop it in the chat box if that's more comfortable for you.
So that, okay, so it's listed on the Nigerian and the London Stock Exchange. So that's kind of why I mentioned that you would have to look at converting that target price that you have, because the financial statements are in Naira and dollars. So once you've done your valuation, maybe in dollar terms, you would have to convert the currency you're using for your valuation to the share price. If you're comparing it to the share price in London Stock Exchange, if you're comparing it to the share price on the Nigerian Stock Exchange, they have financials in Naira as well. So you wouldn't have to take into consideration any conversion of share price, or conversion of target price to other currencies.
Okay, so I'm not, okay. How do we factor in exchange loss along the years?
So with exchange loss, it's another thing that's quite difficult and subjective. The subjective element of it is that the exchange rate, right? You don't know what the exchange rate could potentially be next year or the year after, especially in Nigeria, as you probably know. So I wouldn't worry too much about forecasting exchange rate loss. That would be something that would be very, very difficult. Often analysts do it. I mean, I do it, but I only look at it maybe on a 1 or 2 year basis, and I'll be honest, it's not with great precision. It gets a bit better in terms of accuracy as the quarters move along. So I wouldn't worry too much about exchange rate loss at this point. I mean, if you're forecasting in dollars and you're valuing in dollars, the exchange rate loss doesn't really come into it too much, to be honest. It's when you're looking at forecasting in Naira. And I think as Wale mentioned, it's better to look at Seplat in dollar terms, because the key driver of the valuation, the oil price, is in dollars. So it's just a lot easier in that sense.
Can you see the question from Oluchi?
Yes, so in terms of the NAV method, no, there isn't too much difference. It's just that the NAV starts to take into consideration your 2C reserves and starts to incorporate a chance of success. That's the main difference with the NAV and the modified DCF. The main thing that the NAV also has is that it focuses heavily on the 2P reserves. So the driver of the NAV method is the 2P reserves. So in terms of the valuation, it won't be too different because when you start incorporating your 2Cs, you may have 2C reserves of 50 million, but the chance of success may be 20 million. And by the time you factor in the timing and etc., it doesn't make a substantial amount of difference to your valuation. And then for the sake of simplicity as well, I just wanted to focus on this modified DCF as well. So from this modified DCF, you can progress to NAV method and it will be very, very easy for you. Do we have any other questions?
Okay. Can you please go over tax balance sheet?
Okay, so for taxes, I mentioned that it's quite complicated because of the capital allowances and the deferred taxes that you have to take into consideration. It would require you building a schedule to take into consideration your capital expenditure, the amount of capital allowances that are received every year, the amount of capital allowances that can be applied to your profits. And quite frankly, it's quite complicated and I didn't want to bring it into this exercise. So that's why I didn't mention it in too much detail.
Okay, there are no more questions. Okay, I'm just holding on to see if there will be any more questions. Otherwise, we can, Wale, you can give us the closing remarks.
Okay. Thank you, Gloria. I think I want to say a big appreciation to Ayodeji Dalu for the bootcamp today. I think Ayo has taken his time out to, in a very simple or in a very in over 2-3 hours, to just take us through how to think about how to arrive at valuations for oil and gas companies. I think he's done quite a thorough job over that period. What we'll do is the recording for this session is available, as well as the slides as well. They're also available. So I will share those with you after the presentation. Myself, I think I gained a lot from listening to Ayo. Okay, I see Abioda's hand is up. Does he have a question? Okay.
Yeah, good afternoon. I just want to appreciate Ayodeji for the extensive presentation. I mean, I listened to a large amount of the presentation. I was actually on the road driving, but it was actually very extensive. And I just want to appreciate him. Well done, and thank you for this opportunity. I just want to say that before we round up.
Okay. I see there's a question from Oluchi that modified DCF is a superior method. Well, to be frank with you on valuation, so what the institute says is that we want whatever method. There are no right or wrong answers with valuations. I mean, whatever method you choose to value the company with, just have a justification for that, and preferably you use more than one method. So if you have 2-3 methods, yes, that was what. Don't say it's one method, or if I don't use that method, yeah, is it? I mean, whatever method you use, try and have a basis for or rationale for using that method, and importantly, and try and use 1 or 2 methods more than not just one method, because if there's any one thing, the real world involves many variables. And so because the real world, every valuation model you use typically make certain assumptions, which in the real world, all kinds of things are happening at the same time. So you want to have different perspectives. And so using not just modified DCF, relative valuations, typically those two, typically, if you can use those two, typically it tends to make, provide different perspectives of how to think about and valuation. So for when the graders are agreeing, they always want to check if you use the method, why did you use that method? And then did you use more than one method as well? So teams that use more than one method and also provide justification for why they use different methods tend to, so there's no answer that if you use this one, that's way. Some other people can say, well, we just use relative valuation, provided they can justify why they use it, and then they use other methods as well. Sure, they'll get more marks for that. So yeah, so there's no, it depends. What my sense, and maybe I can chip in here, is that valuation is often from the perspective of who is using it. So if, for example, you want to sell an asset, you own an oil and gas asset and you want to sell it, the valuation methods you will be leaning more towards will be different ones. Whereas if you also want to buy an oil and gas asset, you'll be looking at things from a different perspective. So there's never really one right or wrong answer. So having multiple approaches helps because it tends to give different perspectives. And when people are thinking about valuations, but from our perspective today, we're making the assumption that we want to make an investment into this company, and so how should we be thinking about it? And I think the modified DCF helps you think about it. Relative valuation also helps you provide context about valuation as well. So other methods, but I think the key thing to just state is that you can use more than one method, but just have a reasonable basis for why you're using it. That's very important. Okay, I think spend the better part of today, and we'll try and round up by shortly. Just want to thank Ayo as well as everybody, also from the society office as well. Gloria, thank you for staying with us and helping us put together this event, as well as Yemi as well. And I'd also like to thank everyone, the students as well as the faculty advisors for being here with us. Wish you all the best as always. And please reach out to us if you have any problems or any issues, and we'll work things from our end. All right, then. I think we can call it a day. Have a good weekend, everybody.